Why does it matter? Introduction. When it comes to global economic powerhouses, few entities wield as much influence as the Federal Open Market Committee, FOMC. But what exactly does this committee do, and why do its decisions send ripples across global markets, including the South African rand? Whether you're a business owner, an investor, or simply curious about how the economy works, understanding the FOMC is key to grasping the interconnectedness of global markets. In this video, we'll break down the role of the FOMC, explain its decisions with relatable analogies, and highlight instances where U.S. monetary policy shaped economies worldwide. The role of the FOMC? Setting the tone for global markets. The FOMC is a branch of the U.S. Federal Reserve tasked with managing monetary policy to ensure economic stability, comprised of 12 members, including Federal Reserve governors and regional bank presidents. The FOMC meets regularly to decide on critical issues like interest rates, which influence borrowing, spending, and investment. At the heart of these meetings are discussions on whether to raise, lower, or maintain interest rates. For example, when inflation rises, the FOMC may increase rates to cool down the economy by making borrowing more expensive. Conversely, in times of recession, they may lower rates to stimulate economic activity. The committee's decisions are recorded in meeting minutes, which are analyzed worldwide to predict future monetary policies. Why does this matter globally? The U.S. dollar is the world's reserve currency, meaning changes in U.S. monetary policy often have a cascading effect on other currencies, including the South African rand. Investors, businesses, and governments watch these minutes closely to adjust their strategies accordingly. Understanding FOMC concepts, relatable analogies. Think of the FOMC as the thermostat of the global economy. When the economy is overheating with high inflation, the FOMC raises rates to cool it down. When it's too cold during a slowdown, they lower rates to warm things up. This delicate balance affects everyone, from a small business in Johannesburg to a multinational corporation in New York. Interest rates, a key tool of the FOMC, are like the cost of borrowing money. Higher rates discourage people from taking loans, leading to less spending and investment. Lower rates, on the other hand, encourage borrowing, stimulating economic activity. However, these changes can significantly impact currencies. For instance, if the FOMC raises rates, the US dollar strengthens as it becomes more attractive to investors seeking higher returns, often weakening currencies like the rand in comparison. Consider this. If you're an importer in South Africa, and the rand weakens due to a strong dollar, your costs for U.S.-sourced goods increase. Conversely, a stronger dollar might make South African exports more competitive in international markets. These dynamics illustrate the far-reaching implications of the FOMC's decisions. Past instances of FOMC influence on emerging markets history provide several examples of the FOMC's impact on global economies. During the 2013 taper tantrum, when the Federal Reserve hinted at reducing its quantitative easing program, emerging market currencies, including the rand, plummeted.